This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
It took us some 5 chapters to deal with the self-employed. But of course, the vast majority of UK taxpayers are not self-employed. The vast majority, with taxable income anyway, are employees. Thankfully, it'll only take us 1 chapter to deal with employment income. But again, it's a fairly substantial chapter and a very important one so far as we're concerned. There will always be elements of employment income and the assessment thereof within our examination, whether that be the one-off questions, objective testing questions in section A, or whether it's a part of a bigger question, the income tax question within section C for 15 marks. We start, obviously given what I've just said, with the scope of employment income. A self-employed person is taxable under the trading income rules, as we've just spent 5 chapters looking at, whereas an employee is taxed under the employment income rules. So one initial issue that needs to be dealt with is to determine whether an individual is actually in employment or self-employment. Now, that is very, very obvious in terms of the activities that the individual undertakes. But if you recall, back at the very beginning of our studies of trading income, we had to make a call there between what represents trading when you sell something and make a profit on it, as compared to what would be a capital disposal and a capital gain arising on its disposal. So those were called the badges of trade. What we've now got is another question that needs to be answered and guidelines laid down for us that we need to be aware of how do we distinguish between employment and self-employment. Now, there are certain basic principles here that exist, which we should know, and then you'll come to terms later, not immediately, but closer to exam date. We're looking at far more detail in terms of the specific points that will determine whether or not an individual is an employee or is self-employed. The main test of an employment, as opposed to self-employment, is the existence of a contract of service. Notice there, a contract of service. If what you are provided with is a contract of service, then that is a relationship of employer to employee. Whereas if a business has contracted for your services, a contract for services there, then that then belongs to the self-employed. So again, a very basic but important issue to remember. Contract of service makes you an employee. A contract for your services makes you self-employed. Now, if there is no contract of service per se, the following would suggest employment. So, therefore, how do we make that call? There's a whole list there of things that are looked at to try to determine in grey areas what would represent a contract of service and what therefore would represent employment. Now, you don't need me to read them to you, nor, if you are still some distance away from your examination sitting date, do you need to worry about trying to learn any of this now. Have a quick read through in your own time, but they're mostly things that hopefully make sense there in terms of what you are doing. Again, very obvious ones. If the employer controls the manner and method of work, that therefore would appear to take on the position of employment there. An obligation by the employer to offer work and an obligation by the employee to undertake the work offered. An employee would not normally be in a position to decline work when offered. If you're self-employed and someone offers you work, a client there, you don't have to take that. If the employer tells you, I want you to do this, you do it. Otherwise, you go get another job. So again, very obvious statements about what would represent employment as compared to self-employment there. Other obvious ones, the employee, someone who'd be entitled to benefits normally provided to employees, such as sick pay, such as holiday pay. So when you are ill, you still get paid within reason, depending on how long you are sick for. And of course, you have a certain amount of time paid for as holiday as well. So having a look through those, most of them straightforward. Not a major area so far as questions, however, are concerned. What is then assessed? Well, for most people it's ever so simple, that what you are assessed on would be, if you're paid on a weekly basis, your wages; if you're paid on a monthly basis, your salary. So the amount that you are paid as a wage or a salary, whatever you're paid, whatever you receive in the tax year, that would seem to indicate, therefore, what you would be assessed on under the employment income rules. But there are other things as well. For example, if you work for a business that is then successful, we hope, then a part of the profits of the business, once determined, may then be paid out to employees in the form of bonuses. So bonuses would be a part of the emoluments, the employment income that you have. If you are working in sales, for example, depending on the level of sales that you achieve, you may receive a commission on top of your normal salary or wage. And as will occupy most of our time in this chapter, there are then various types of benefit that might, if the employer is so minded, be provided to you, the employee, by the employer. We have to determine, therefore, which of those benefits are actually going to be taxable, and if they are going to be taxable, how shall we determine the taxable amount for any given tax year? So we're told here that individuals are assessed on the amount of emoluments received. That's the overall employment income package there. Wages, salaries, bonus, commissions and benefits. And we're assessed on, as we already know, the amount received in the tax year. Now there's just one little issue here to watch out for in terms of the language used. That you might think that the date received is very obvious. It is the date when you actually received the amount by the employee. You, the employee, actually received it. But when it comes to things like bonuses, specifically there, it's usually where it's tested, then the date received is taken as being the earlier, note the earlier, of the date when, now here's the expression, the employee became entitled to the payment, or the date when it was actually received by the employee. Now, you won't have to worry at this level about trying to define, well, what do we mean by the date when we became entitled to the payment? You'd be told the date when you became entitled to the payment was this date, the date when it was actually received was that date. We take the earlier of those two. Very obviously there, for HMRC purposes, they don't want you to delay when you became entitled to the payment to when you actually received it to cross a tax year. So if I became entitled to a payment, let's say a bonus or commission, I became entitled in March of 2017, but I didn't actually receive it until, let's say, the 10th of April 2017, then there's an issue, and hence why they have the rule here. When you actually received it the 10th of April 17, that's in the 17-18 tax year. Whereas the date when you became entitled, March 2017, is in the 16-17 tax year. It'd be very easy, therefore, for an employee to arrange with their employer, just delay the payment a few days, a few weeks there, maybe a month, so as to put it into the next tax year, so I won't have to pay tax on that for a longer period. That's one possibility there, again, as to why you might do it, but simply enough, when presented with the two dates, you take the earlier of them. When you are preparing an income tax computation for 2016-17, as you may well be required to, of course, in our exam, then you look at those two dates, and if the earlier falls in the 16-17 year, usually that is the date when you became entitled, then you will include that amount within the income tax computation for this tax year. You include it in the income tax computation for the tax year. Whereas if you actually received it, like we said a moment ago, on the 10th of April 17, the fact that it was actually received in 17-18 is ignored. You became entitled in 16-17, and that, the earlier income tax computation, is the one that will be allocated to. So employment income, our emoluments, cover a whole range of things, not just cash. Whether the cash is in terms of wages, salary, bonus or commission, where again date became entitled, earlier of it or when you actually received it, is the date to be used in allocating to a tax year, but also benefits. Again, most of this chapter is given over to looking at the various types of both, in fact, that's quite a long list of them surprisingly, exempt benefits that might be provided by an employer to an employee, but also, of course, the important ones for us to be able to calculate how much, therefore, are the taxable benefits. How do we compute that figure? Because you will be required to do such calculations in your exam. What I've also got to do, however, is to look at the flip side. As well as having income, you, the employee, may incur expenses. So there's a question mark over whether or not expenses that you have incurred during the tax year may be allowable deductions against the employment income that you are assessed on in this year. Now there, if we go over the page, here in section 4.1 we have a list of some pretty notable expenditure and typical expenditure for involvement so far as exam questions are concerned. The following expenditure here is deductible. So these will be allowable deductions in deriving the net employment income to assess in the tax year. Contributions to an approved occupational pension scheme. Now, what we are used to seeing way back from chapter 2 is an individual making contributions into a personal pension scheme and how we treat the gross amount of the personal pension contributions paid. We've seen that in terms of its involvement in chapter 2, and we're going to look at a whole lot more on pensions and bring it all together in the next chapter, chapter 10. But here, if you, the employee, contribute into, and you'd be told that it was an approved occupational pension scheme, basically one operated or run by the employer there or on behalf of the employer, and into which the employer will make contributions. Any contributions that you put in are allowable deductions there. What you might also pay, any fees or subscriptions to relevant professional bodies, like your good selves. It won't be too long, we hope, before you're paying an annual professional subscription to the ACCA there. Now that, if you are again using your professional qualification, your accountancy qualification for the job that you do, you're an accountant or running a business there, it is to do with the job that you do, then that professional subscription paid each year is an allowable deduction against your employment income. We mentioned personal pension contributions a moment ago, and you may remember from back in chapter 2 that that was one way by which you could make a contribution towards your overall pension, a type of pension scheme that you could be a member of. We've now seen occupational. The tax treatment is going to be different. Occupational pension scheme contributions, ever so easy. Their contributions that you make are allowable deductions from the employment income. Whatever you've paid to gross figure, you deduct it. I mention this because what we also looked at, which had basically the same tax treatment as personal pension contributions, was when an individual gave to charity under the gift aid scheme. We saw the same tax treatment, whereby either of those two types of payment, personal pension contribution or gift aid payment, were not deducted in deriving taxable income. Instead, we said that basic rate relief was given at source, and higher and, if necessary, additional rate relief was given by extending by the gross payments made, by extending the basic rate band and, if necessary, the higher rate band. What we now see is that when we deal with employees, they may be contributing not to a personal pension scheme, but to an occupational pension scheme, and we do then deduct in deriving taxable income, to be precise, here in the employment income, we do deduct the contributions made by the employee. And what we also deduct is any payments made to a charity under a payroll deduction scheme. So whereas one way by which anybody could give tax efficiently to charity was the gift aid scheme, if you are an employee and if your employer operates the payroll deduction scheme, here is another way, whereby, it's a very simple way, you tell your employer that you would like, let's pick a number at random, £500 of your gross pay to be given over to a charity or charities of your choice. What would happen, therefore, is that would be an allowable deduction from your annual employment income. So in your employment income working, giving you the figure to go to the income tax computation, you would pick up your gross salary and go less payroll deduction scheme contribution 500, and your employment income is reduced by that figure. The general rule, if I can just skip to this one, for allowability of expenses for an employee is very tight, that you have to satisfy 3 criteria. 2 of them you're familiar with from trading income. That is, the expense must be incurred wholly and exclusively. Not now for the performance of the trade, as was the case with trading income, but in the performance of the duties of employment. But there's a third one as well. That is that it is incurred wholly, exclusively, and necessarily in the performance of the duties of employment. And that makes it quite difficult, other than in these specific circumstances that we're now listing, makes it quite difficult to get much in the way of expense deduction against your employment income assessment. Miss out there the travel expenses. Now, if you personally incur travel expenses, the probability is that your employer will reimburse you in relation to those travel expenses. So you will not incur any net expense, and there'll be nothing to deduct from your employment income and nothing to assess you on in relation to the reimbursement of your necessary travel expense that you incurred there. But if you did incur them personally and they were not reimbursed or fully reimbursed, then travel expenses incurred necessarily in the performance of the duties of employment, they would be allowable deductions. But it would be unusual to find that an employee was expected to incur their own travel expenses in relation to the performance of the duties of employment. Now, what we're not talking about here is simply the employer paying for you to go from home to work each day. That is not something that you have incurred in the performance of the duties of employment. All that is putting you in a position to perform that employment. What we're talking about is maybe going out to visit clients, potential customers, there visit suppliers, that type of travel. If you incur any net cost, then that would be an allowable deduction against your employment income. What would also be unusual is for plant and machinery to be provided by an employee for use in his or her duties. If you needed plant or machinery, you'd expect the employer to provide that and incur that cost. But if you, the employee, were to incur it, then you would be entitled to capital allowances on such plant and machinery, which, as we know, with the AIA would mean that you get immediate tax relief with 100% capital allowance for such plant and machinery incurred. The next one is one that's frequently tested because it's a little calculation, interesting little calculation that is involved, and it may turn out to give rise to either of 2 things. It may give rise to an allowable deduction for the employee, or it may give rise to an assessable benefit for the employee. And what it's about is where an employee uses their own car for business mileage. And what happens, as we've just suggested, if you are going on business travel, then you should be compensated by the employer. Now then, if there is to be no assessment and if there's to be no allowable expense, then the employer should use the approved mileage allowance rates as set by HMRC. And for 2016-17, as you can read here, they are 45 pence per mile for the first 10,000 business miles, and should you do any more than that, 25 pence per mile thereafter. And this again would be where you would be using your own car, not a car provided by the employer, not a company car, but your own car. And you're compensated for the use of that car, and used, and most employers do use these, are these approved, these authorised mileage allowance rates or payments there. And that we use in order to calculate whether there was any taxable income arising, any taxable benefit arising from any mileage allowances received from their employer, but also employees who use their cars for business mileage without being reimbursed by their employer, or more likely, whether reimbursement is less than the approved mileage allowance rates, then we can use the approved mileage allowances as a basis for an allowable deduction. So where, as will be the case in an exam question, the employee is reimbursed at a rate or rates other than these authorised rates we see here, this information, by the way, is provided to you on your rates and allowances page there, so you can look that up, but again, probably one of those that you'll have learned by then anyway. But if the employer uses rate or rates other than those, then we have to compare the approved mileage allowance payments, rates, that you have been paid with what you've actually been paid. What are the approved mileage allowances compared to the actual payments made? So let's have just a little example to illustrate how this might work. So you might be told that during the tax year 16-17 that the employee, so we can write with, the employee used their car for 14,000 business miles. 14,000 business miles. And those 14,000 business miles were reimbursed at a rate of 35 pence per mile. Obviously a rate different to that which is laid down as being the authorised, the approved mileage allowance payment. 14,000 business miles reimbursed at what is a standard rate of 35 pence per mile. So what we've got to do here to determine the position for the employee is to compare what you actually got, 14,000 at 35p. Now if you put that through your calculator, I think that what that comes to is £4,900. 14,000 at 35p. And we compare what you actually got with the authorised, the approved rates. That would have been 10,000 times 45p. That would equal 4,500 plus 4,000 at 25 pence per mile equals 1,000, and that therefore would give you £5,500. So the approved rates would have given you £5,500. What you've actually received is £4,900. There is a difference there of £600. Now, how will we treat that? You should have been reimbursed by £5,500. Your employer has only reimbursed you £4,900. Therefore, that difference of £600 would be an allowable deduction here, an allowable deduction against your employment income assessment. You therefore could deduct £600 in deriving your employment income assessment. Compare that with, say, what would have happened if you had been reimbursed at a standard rate of 40 pence. 14,000 at 40p is, I think, £5,600. You've actually been reimbursed with 5,000. The actual reimbursement is 5,600. The authorised rate hasn't changed, of course. That's still £5,500. So here you have received from your employer £100 more than you should have done overall. At 40p was £5,600, whereas the authorised rates would have allowed you only 5.5. So that £100 would be an assessable benefit. That's what makes this calculation a bit more interesting, because the outcome could take you either way. It could either be an allowable deduction, as in the case of the 600 there, or it could be an assessable benefit in the case of the 100 there. So make sure, therefore, you know how to do those calculations, and to assist you with that, naturally enough, you've got a simple little exercise there for you to have a go at, which you can have a go at now and pause if you so choose, or at some later point. Moving on, having dealt with deductions and also the possibility on the last one of an assessable benefit, we now turn our attention to look at those benefits. And to begin with, we have quite an extensive list of what are exempt benefits, probably bigger than you might have thought it to be. Often they will not count for very much, or there'll be very limited uptake in relation to them, because of course it would demand that the employer is actually providing and incurring a cost here themselves, providing the employee with that benefit, which is maybe something that they're simply unwilling to do. So what have we got here? Now again, you can read through these, but let me pick out some of the ones that again we see on a regular basis in the exam. Canteen. You've got a subsidised canteen. Now as long as it's available to all staff, or it might be there's a works cafeteria and a management restaurant, as long as the basic for the provision is the same there to all staff, then that is an exempt benefit. If you're required to move, so your employer moves you from the London office to the Birmingham office there, then if they pay removal expenses, as you'd expect them to do, if that's what they want you to do, they want you there rather than in London, then removal expenses of up to £8,000 would be exempt. So if the company paid £10,000 worth of removal expenses, £8,000 is exempt, £2,000 would be left as an assessable benefit to include. Car parking spaces at or near the place of work. Yeah, surprisingly we might think these are an exempt benefit. Now that would also include the situation where it's not just your company car park, there is a car park that the employer owns that surrounds the place of work there, the factory, the office, whatever it might be. But also if the employer didn't have such a facility, but they paid for, say, a season ticket for you to go and park in a private car park. Those are exempt benefits there. Workplace nurseries, otherwise known as a creche there. Notice workplace. So this is one that's operated by the employer. That is exempt. Now, not all employers are going to be in a position to be able to do that. And if all the employer does is to pay your childminder or give you sufficient money to pay your childminder, whatever it costs there to look after your children while you come to work, that would be a part of your income and would be fully assessable. An authorised and proper way of doing it would be to provide childcare vouchers here to employees, where these too would be an exempt benefit, depending on how much and the level of taxpayer that you are based upon your employment income. That if you're a basic rate taxpayer, there's an exemption level of £55 a week. Now, if you're a basic rate taxpayer, you're paying tax at 20%. £55 at 20% would be £11 there. So it's saving you each week £11 worth of tax. If you're a higher rate taxpayer, then the exemption is £28 per week for a higher rate taxpayer. The reason being 28 at 40% Well, it's a little over £11 there. I think, what's that, £11.20 there. But what you can now see is if higher rate taxpayers got the same £55 a week, they would be getting double the taxation benefit. That would be saving them £55 at 40%. That would be £22 instead of £11. So the idea was to be fair to all. You'd all get effectively the same tax benefit. When it comes to additional rate taxpayers, they are down to £25 a week, which if you then multiply it out at 45%, again you would find a figure close to £11 there. So that's the idea, that everyone effectively gets the same taxation benefit, rather than those who are higher paid getting effectively a bigger tax deduction. So those are the exemptions. The way that it then works in an exam question, you might be told the taxpayer is a basic rate taxpayer and is provided with £70 per week worth of childcare vouchers. That means the exemption is 55, actual 17, 75 minus 55 is £15 a week. If this had happened through the whole tax year, times 52, and that would be the annual assessable benefit for your tax year. So just compare, based on a basic, higher or additional rate, compare the exempt level with whatever you're being paid, and the excess then becomes an assessment. Contributions by an employer to an approved pension scheme. Now, if your employer operates an occupational scheme, then they're required to make contributions. That, therefore, what your employer puts into your occupational pension scheme is an exempt benefit. Now, this means that pension contributions are hugely tax efficient. We've already seen in this chapter that any employee contributions are allowable deductions in deriving your taxable employment income. You get tax relief on them. And now what the employer puts in to such a scheme is an exempt benefit. Very good news indeed. Now, the employer might not operate such a scheme. It hasn't got the resources so to do, in which case it may then make a payment into your personal pension scheme. Contributions by an employer to an approved, whichever one it is, pension scheme, that would be an exempt benefit. I don't think we need to worry about the workplace parking for bicycles there. Provision of a mobile telephone for private use, one per employee. Yeah, if you're provided by your employer with a mobile phone, you don't have to worry about, well, some of it was business, but a lot of it was private. The full cost of that is an exempt benefit. If for whatever strange reason you were provided with two phones, then the second such phone would constitute an assessable benefit and will be treated, as we'll see later in our studies of taxable benefits, as one of the other assets made available for private use. So one per employee is exempt. The staff Christmas party, again here for staff, up to £150 per person per year is an exempt benefit there. Sport and recreational facilities available generally for the staff. If there's again a sports ground, sports facilities, a gym that they have, anything like that, that would be again an exempt benefit. Sport and recreational, annual exemption of £500 per employee, where the employer pays for medical treatment to assist the employee in returning to work after a period of absence due to health or injury. Now, it's not a hugely important one, but it's relatively recent, just came in a couple of years ago, and on that basis might still be in the mind of the examiner and therefore might get tested. But they're £500 per employee, where the employer pays full. So it's not the employer paying for private health insurance, pays for medical treatment to very specifically assist the employee in returning to work after a period of absence due to ill health or injury. If you're all about to be made redundant outplacement counselling services there to employees, exempt benefits. If you work at home for part of the week, contributions towards additional household costs, your heat and light, incurred by an employee who works at home, up to £4 a week, or, if higher, evidence must be provided by the employee to justify the expense, but you just be expected to know the £4 a week level. Other ones there, now again, come sort of a year or so, I probably won't even mention it, but that what is the name? Trivial benefits. Only reason I mention it is it's new, just brought in the Finance Act of 2016, and things that are new are often things that get tested. In the great scheme of things, it's not particularly important, but trivial benefits, which we define here as those costing no more than £50 per employee, and which are not cash or cash vouchers. So that gives a little bit of license for, again, some sort of small benefit to be provided. The employer buys a little something there for the employee, and you don't have to worry about putting that in your employment income assessment if it cost no more than £50 for you, the employee. Another one that often comes up, incidental overnight expenses. So you're working away from home for your employer. They'll no doubt pay for your travel, as we've mentioned earlier, and no doubt for the hotel. But on top of that, incidental overnight expenses. For example, phoning home there from either in the UK or overseas, we have a level of exemption, up to £5 per night if you're in the UK, and up to £10 per night overseas. There's a strange little rule here, and that is if you were reimbursed, you were given an expense allowance here in excess of those amounts, the full amount would be assessable. So if on your overseas business trip you were provided here with expense allowance of £12 per night, i.e. above the £10 a night limit, all £12 would be assessable, not just the excess of £2, 12 minus 10. The whole £12 would be assessable. So there's quite a lot in that list, but there's nothing probably of huge significance, as compared to the major areas that we see in terms of taxable benefits here. Now, the basic principles, the amount assessed is generally the cost of providing the benefit. One small issue, that is, if we're talking about an in-house benefit, then it will be the marginal cost incurred by the employer, not the full cost, or indeed the sales value. For example, you work for an airline and you're provided with free air travel as an employee of that airline company. You wouldn't be charged the full amount. All you'd be charged would be any marginal costs that attach to that. Now don't worry, you don't have to work out what that is. It's not a management accounting exam. You'd be told what is the marginal cost. If you're provided with any vouchers that are exchangeable for goods or services, they, unless specifically exempt, like the childcare vouchers we've already mentioned, would again be taxable. But then a main one that we see, living accommodation. That one comes up an awful lot. Comes up on a very regular basis. Now what I'd like you to do here, therefore, just for a moment, is just to read through. You don't need me to read it through to you, though I will take you through this. Just read through and familiarise yourself with the information. Let's see what is ahead of us here, what you need to learn. I'll then take you through it and pick out what the key issues are and explain with an example how we deal with that. So just pause the session for a moment while you take a little read through that information, please. Okay, let's see therefore what you've gleaned from your little read through. First issue, Again, nothing for you to worry about at this point, but come back to it closer to the exam. That is, if the accommodation is job related. And we define there the three circumstances in which accommodation would be defined to be job related. It's necessary for the proper performance of the duties, it's required for the better performance of duties, or we're talking about security reasons. Any of those, then we don't have a taxable benefit regarding the accommodation itself. If it's not the job-related accommodation, then we've got to work out an assessable benefit. And the first thing then that we need to know is whether or not the accommodation, the property in question, is owned, it's been purchased by the employer, or it is rented. Because the first part of the calculation of the benefit, this usually comes in two parts. The first part, the hire of the accommodation's annual value, don't worry about that term, it is a figure that will be given to you. The accommodation's annual value, or the rent actually paid for it by the employer. Now clearly that's only an issue if the property is rented. And if it is a rental property, then that's it. It's the hire of those two things, reduced, if of course it happens, by any rental contribution paid by the employee to the employer for the benefit of living in it. But in the vast majority of questions that you get here, it is a property that is actually owned by the employer. It's been purchased by the company for the use of employees. In which case, you'll be picking up here the annual value. So the first thing to pick up as part of the overall assessment, the annual value of the property. That therefore is, read it in the question, copy it down into your answer. So no work to be done. But then a question that needs to be answered. And that is whether there's going to be an additional benefit, often referred to as the expensive accommodation benefit. And there is an additional benefit here where the cost, and I'll come back to that in a moment, of providing the accommodation is greater than £75,000. So if the costs on purchasing that property, if they exceed £75,000, which in most circumstances they will, then there is an expensive accommodation benefit. And it's a simple calculation. Whatever that cost is, you will be told what that cost of providing the accommodation is. The cut-off we said was £75,000, so the cost minus £75,000 times the official rate of interest. That figure will be given on your rates and allowances page, but you'll probably know it by then. It is 3% for our 16-17 tax year. Now, the cost of providing the accommodation is the purchase price of the property plus expenditure on improvements incurred before the start of the tax year. So in working out that cost figure, the original cost plus maybe since acquisition, the company has then built a garage on it, put a conservatory on it, put an extension on it. If those costs, those additional enhancement, improvement, those capital costs have been incurred prior to the start of this tax year, then we add those in working out the expensive accommodation benefit. Look very carefully, therefore, where they give you a list of capital expenditure incurred, because if any of that is within the current tax year, that is ignored in working out the expensive accommodation benefit for this year. It will be taken account of in working next year's benefit. We said there about the cost of providing the accommodation, but what may happen is if the employer bought the accommodation more than 6 years before first providing it to the employee, the property's market value when first occupied by the employee is used in the calculation instead of purchase price. So if you were told, therefore, that the company had originally acquired the property in 2006, so some 10 or 11 years prior to now, then they bought it in 2006 at a cost of £100,000. As the cost is 100, it's more than 75, it's expensive accommodation. So there is an accommodation benefit, an expensive accommodation benefit to compute. But then you're told that the employee who now occupies the property moved into the property. Now, look at what the note says. If the employer bought the accommodation more than 6 years before first providing it to the employee. So the company bought it in 2006, and this employee, now in the 16-17 tax year, only took up occupation in 2015. Well, 2015 is more than 6 years on from 2006, when the property was first purchased by the company. So the employer bought the accommodation more than 6 years before providing it to this employee. Therefore, instead of comparing the cost of 100,000 with the 75,000 expensive accommodation benefit limit, we would instead look at the market value in 2015 when the employee first moved into it. It doesn't matter what is the market value now in the 16-17 year. What matters was the market value when he first moved in. That again only used where, one, the original cost was firstly more than 75,000, otherwise it is not expensive accommodation and therefore there is no benefit to compute. And assuming that, as in this example, the cost was more than 75, we still only use the market value when he moved in, if when he moved in, or she I should say, if he or she moved in there, that the employer by that date, for us 2015, had already owned it for more than 6 years. My example, bought in 2006, clearly that's more than 6 years, so you'd use the market value in 2015. Again, as that would be a higher figure. So if that was £160,000, it is that you compare with the 75 rather than the cost. Remember though, as I've just said in that little statement there, note that if the cost itself is less than 75,000, then there is no expensive accommodation benefit to compute, irrespective of whatever the market value might have been when the employee first occupied the property. So if in my example the company bought it in 2006 for £50,000 and then our employee moved into it in 2015 when it was worth £150,000, the £150,000 is irrelevant. There is no expensive accommodation benefit. Why? Because it didn't cost more than £75,000 in the first place. Okay, I'd like you to have another think about that, and what we'll do, we've now come to the end of this session, but at the beginning of the next session we'll work an example based on that information there, and then move on through the additional benefits that are contained within this extensive chapter. I look forward to talking to you again then.